Most executives I've coached have lost over $100,000 in the markets, sometimes in one brutal trade, others in smaller decisions that added up over time. And here's the thing, they all seem like smart, cautious moves at the time. Sounds familiar? Now, if you're smart and still losing money, this is for you. Because the real problem isn't your talent, it's avoiding 5 simple mistakes that our jobs have actually trained us to make. Now in this episode, I'm going to walk through all 5 and more importantly, how you can avoid them. Mastery not required, of course. I've coached a lot of executives. I've seen it over and over. Intelligent people making intelligent mistakes. Not because you're careless, but because you're playing the wrong game with the right skills. So let's fix that. Now, as promised, here are the 5 mistakes that cost the most and how you can avoid them starting today. Okay, mistake number 1. Thinking like a deal maker, not an owner. See, here's the thing. Corporate types like us, we're trained to chase exits and valuations, right? That's the kind of wins that get us promoted. Now remember Goldie? We spoke about that in the last episode. That's my guitar that tripled in price but paid me nothing, right? That's how most executives invest. We buy for appreciation, not income. You approach your portfolio like a deal, right? You look for the big wins, the strategic acquisition, so to speak, the asset that doubles in 3 years. Now that's fine for a corporate investment arm, but for your personal portfolio, real wealth comes from ownership that pays you. Now think about the great companies you've worked for, right? They didn't grow in a vacuum. They generated consistent cash flow, predictable revenue, and paid dividends to shareholders while reinvesting for growth. Yet, with your own money, you abandon that model. You buy assets that produce nothing but hope. Now, don't invest that way. Like I've said time and time again, if it doesn't pay you, it's not an investment, it's a bet. So let me give you a quick test you can apply right now. I call it the pay me or pass test. And it involves asking yourself just 3 simple questions. First, does it pay me? Whether in dividends, cash flow, reinvested profits. Next, ask yourself, is this payment predictable? Is it based on productivity or is it based on height? And third, can I verify it myself, right, from statements and understanding the business? And don't let this intimidate you, right? Understanding the business doesn't need to be complicated. You work on Microsoft Office, you understand that model, right? Microsoft sells software. You watch YouTube, you understand that model. They show you ads or you've paid for a subscription. If you answer no to any of these questions, then pass. Now take a moment to ask yourself, how many of your current investments actually pay you? Are you holding on to assets that don't pass the pay me or pass test? Drop a comment below. I'd love to know. And if you're not sure how to apply this test to your portfolio, stick around. I'll show you how in my free workshop. Now, mistake number 2, confusing complexity with competence. Now, you didn't get successful at work by accepting the simple answers, right? Now, in business, complexity often signals sophistication. So when a banker pitches, principal protected structured note with upside participation, right? It sounds executive level smart. Now, I learned this the hard way because complexity makes you feel smart. But guess what? It's simplicity that makes you rich. I'd rather be rich than feel smart. I once invested in a diversified global fund. Okay, it sounds responsible, right? Diversified and all that, right? It looked sophisticated with notes, credit-linked instruments, hedges, and the diversification turned out to be a mirage, right? More than 60% overlapped in global real estate. And hey, the 2008 meltdown, right, took care of the rest. Now, comparatively, my best returns are from boring ETFs, productive income-producing stocks in businesses that I understand, REITs that deposit cash every quarter, and these are simple businesses that I understand, that pay me for owning a piece. And here's my rule of thumb. The simpler, the better. Now use my dinner table test. So before investing, ask, first, can I explain how it makes money over dinner in 3 sentences or less? Would my spouse or friend get it? No diagrams or jargon. And finally, and this is the most important one, Am I leaning on complexity to feel smart? Now, if you can't pass this test, walk away. Now, have you ever been tempted to invest in something just because it sounded sophisticated? What was it and how did it work out for you? Let me know in the comments. And if you're finding this helpful so far, hit that like button. It helps more people discover this content and avoid these costly mistakes. So here's what we've covered so far. Don't do deals, get ownership. Focus on simplicity over complexity. And if you're ready to start building wealth predictably, let me invite you to my free 4-day predictable income plan workshop. It's a video workshop where I do a deep dive over 4 days so you can start building wealth predictably using simple mindset shifts. No mastery required. Get free access at start.purposetree.com/workshop on screen right now or in the show notes below. But we're just getting started because even if you avoid hype and buy good assets, you can still lose money if you get the timing wrong. And that brings us to mistake number 3, ignoring the game of cash flow timing. See, this one really hurts because they've done everything right up till now, right? They avoided the hype, bought good assets, but they made this one mistake that I keep seeing. Once they find a good asset, they know it's going to go up, but instead of watching the price or their cash flow, they get into this great asset too fast and then they run out of cash. And when life throws them a curveball, they end up needing to sell some, perhaps at a loss, because they needed the cash. Because even good assets don't go up linearly. They go up and down and up and down and up. Right? That's how good assets can hurt you if your cash flow and your timing are mismatched. I once advised an asset-rich company that was technically insolvent. Now, on paper, it looked unstoppable, right? An impressive portfolio of real estate, patents, inventory. But when bills came due, it couldn't pay, and it couldn't turn its assets into cash fast enough. Ouch, right? I realized then how important it is to have personal income and a cash flow cushion, because you don't know where the markets will go. Right? Income and cash flow is the lifeblood of a business and your wealth. Because you might own great assets and even look wealthy on paper. But if your assets don't pay you, if they don't generate cash when you need liquidity, if you're not holding enough cash or have an income buffer, you're literally one crisis away from having to sell at the worst possible time. I've seen it happen to too many good people, and I really don't want that to happen to you. So here's what you can do right now. Map your predictable inflows, right? Your salary, your bonuses, your business income against your obligations. And build a cash reserve that fits your life stage and risk tolerance. I'd say at least 6 months. And own assets that complement your cash flow pattern, not complicate it. And if you have a surprise expense tomorrow, would you have the cash flow to handle it without selling off investments? Or are you asset rich but cash poor? Share your thoughts below. And if you're not sure how to structure your cash flow or build reserves, my free workshop walks you through it step by step. Links in the description. Now, mistake 4 is delegating without understanding. And this one hurts to speak about because for years I was too busy, you know what I mean? So I delegated my personal investments to bankers and fund managers. Now by day I gate-kept billion-dollar deals, but by night I signed investment statements I barely understood. And the irony wasn't lost on me. Eventually. Right? Here's what I found later. Diversified funds could be concentrated bets across similar sectors using different instruments or across different geographies, like the global diversified fund I told you about earlier that I got burnt by. Things like principal protected products are only protected at maturity. If you need cash early, no protection. And this is the big one. Fees that compound faster than returns. Right? Compound interest is your best friend when building wealth, but only if it's working for you and not against you. And often, if you read the fine print, you might be paying your fund managers as much or sometimes even more than the money they're making you. Because you can delegate execution, but never accountability. Because at the end of the day, it's your money. It's your retirement. You've done well in your job or business, so you know this stuff. Like the same analytical skills that got you here work just fine with money. You don't need a portfolio manager, and you don't need to be a portfolio manager yourself. But you do need to know what you own and why you own it. So here's what you can do right now. Right? Read one statement a month with curiosity, not blind trust. Right? Ask questions. Don't be afraid if your advisor throws around jargon. Remember step 2 on complexity? Right? This is your money. If your advisor can't explain it simply, find a new advisor. And when was the last time you actually read through your statements? Do you know what fees you're paying? Drop a comment below. And if you're ready to take control of your portfolio, my free 4-day predictable income plan workshop will show you how to build wealth predictably without needing to rely on jargon-filled advice. So by now, we fixed the mechanics, right? Ownership over fancy deals, simplicity over complexity, cash flow, not FOMO, and understanding over delegation. But that's not the most expensive mistake, because the biggest cost isn't money, it's meaning. And that's what mistake 5 is all about, treating wealth as a goal and not a tool. See, when I left law in 2016, I was living the dream, right? Financial freedom, replaced my corporate income with simple businesses and income investments, and finally I had time with my family. Now life was good, but something felt off, or rather incomplete. I was treating wealth like the ultimate KPI. Right? I hit the target, right? I won the game. And that's how we're conditioned as business executives, right? But so what? Why did I want to leave corporate life anyway? Because wealth isn't the goal. It's the tool that funds your purpose. See, friends started asking how I did it, and I shared every strategy, every system. But most struggled, right? They tried to master everything, right? Trading, marketing, automation, because that's how we win at work. But building wealth through mastery doesn't lead to fulfillment. If you build it with complicated tactics, you're going to maintain it with the same level of complexity. The truth about complexity, which we saw earlier, is that most don't even succeed with it. Now, what worked for me wasn't mastering more skills, it was alignment. I applied the strengths I already had and did it purposefully. And that's how Mastery Not Required was born. I now teach others how to build wealth tied to their purpose without mastering a bunch of complex skills. Because you can build a profitable portfolio and still feel poor if it isn't aligned with your purpose or your goals. And if you're working 8-hour days just to keep your not very passive income. Because purpose, as it's taught out there, tends to be airy-fairy, but it doesn't have to be. It can be a practical filter. It tells you where to invest or what to invest in or how to invest and why it matters. So here's your action step. Ask yourself, what's my wealth for? And when that answer is clear, every investment decision gets easier. Because once you do that, you don't just make more money, you multiply what matters to you. So the real question isn't how much wealth you can build, it's what you're building it for. What's your wealth for? Is it just a number you're chasing? Or is it a tool to fund something bigger? I'd love to hear your perspective, right? So share it in the comments. And out of these 5 mistakes, which one do you think has cost you the most so far? And which one are you ready to fix today? Let me know in the comments as well. And if you're ready to align your wealth with your purpose, join my free 4-day predictable income plan workshop. It's completely free, and I'll walk you through how to build wealth that not only pays you, but also multiplies what truly matters to you. Link in the description. Now, wherever you are today, whatever you've lost, remember this. Your past mistakes don't define your future. You've got this. See, it wasn't that you're bad with money or that the markets are rigged or that you need to master some new skill. It's just that you probably misapplied strategy you heard from some guru, or that you were trained to maximize deals, not look out for income. But I want you to know that the same strengths that made you successful, the focus, the structure, the systems, can make you wealthy and get you financially free when you apply them to the right assets and manage your risk and cash flow. You see, you don't need new skills to build wealth. need to apply the skills you already have to productive assets that pay you predictably. So stop thinking like a deal maker chasing the next big exit. Start thinking like an owner, building a portfolio that pays you whether the markets rise or fall. Are you ready to stop making expensive mistakes and start building predictable wealth? Then join my free 4-day predictable income plan workshop. I'll show you the exact filters I use to build wealth that pays you in any market, no mastery required. And before you go, let me know in the comments, which mistake are you most excited to fix? I'd love to hear from you. And if you found this video helpful, hit that like button, subscribe to the channel, and share this with someone who needs to hear it. Thanks for watching, and I'll see you in the next one.